Hey, Dan Passarelli here. How are you feeling today, friends? All right, we've got a really important presentation today. This is gaining edge on your option trades. In some ways, this is going to be a little more advanced, but I'm a big fan of trying to take those advanced concepts and make them simple because in reality, there's not beginner, intermediate, and advanced traders. There are traders who know what they need to make money, and there are traders who don't. So let's talk about gaining edge on your option trades. But first, I want to make sure you can hear me. Please make your way on over to the questions box and type the word edge if you are interested in, well, if you can hear me, actually, I guess. Type the word edge if you can hear me. Claudio, Fan, Baron, Dave, Michael, James. All right, you guys are cool, man. Vano, Richard. Okay. Now, before we get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. Now, I recognize some names here of old friends who are with us every week. Not old like, elderly, but old as in familiar. We know each other. But I see some folks who are not people that whose names I'm familiar with. And so you might not be familiar with my name. So let me introduce myself. My name is Dan Passarelli. I am an author of two of the most popular option trading books, The Market Taker Edge and Trading Option Greeks. Trading Option Greeks is the one I'm most known for. It's been rated one of the top 5 options books written, which is a great honor. And I am a trader, an investor, traded professionally on the floor of the Chicago Board Options Exchange, Chicago Board Trade, CME Group, and now traded upstairs. And now I trade in a retail trading account just like you. I'm the founder of Market Taker Mentoring, which is the global leader in option trader education. We have student traders in over 50 countries. We've put tens of thousands of traders through our program. And I am a trading industry collaborator. I work with all of the options friendly brokers out there like Firstrade and other ones, all of the options exchanges, literally globally. I think I've had some contact with all of them in some sort of advisory type capacity. And I'm a family man. Those of you who are market taker student traders already, you know my wife, Kathleen, who runs operations for Market Taker. And I have my 2 adult children. And besides trading, I and my family, we love to do other fun things like running. I'm a runner. My wife is. We both run some marathons. My daughter's training for her first half marathon. And we're foodies. We like to eat. We like to cook. We like to go to restaurants. We like to travel, enjoy new cultures. We enjoy music. So that's us. Now, let's talk about the important person here. That's you. You are here to move forward in your trading. You're not messing around. So, in addition to all the important things we're going to talk about today, I also want to get you this. This is my podcast, Wealth Building with Options, and it will help you to master covered calls, cash secured puts, great for wheel investors of all experience levels, and a whole bunch more adjustments, your mindset, strike selection, options analysis, a whole bunch more. I mean, this is great. There's new episodes weekly and it's free. In fact, an episode just came out today. They come out every Tuesday morning. So today would be a great day to start and to binge. Just go to anywhere you listen to your podcasts, Apple Podcasts, Spotify, really anyone, YouTube. Just find it, search for Wealth Building with Options. Or if you already listen on Apple, just go to markettaker.com/ApplePod or markettaker.com/SpotifyPod. And that'll take you right to the Wealth Building with Options podcast. And I know some of you don't listen to podcasts. There was a survey done recently about 50% of Americans have listened to a podcast in the last year. So not necessarily a majority, but a lot of people. If that's not you, if you've never listened to one and you're like, I don't know, what is a podcast? Why do I want to do that? Just try it out. Try it out. Do it while you're gardening. Do it. I do it while I'm running, while you're walking the dogs, while you're driving. Podcasts are great when you're driving. It's all audio, no video. So it's very easy to multitask, but give it a shot. All right. Now we're getting into the serious stuff. Okay. So you ever look at like the Firstrade options chain and you look at it and you say, okay, there's all these bids and asks. I don't know. I guess if I want to buy these calls, here's the offer. That's the price I have to pay. You ever do that? Well, yeah, that is kind of how it works, except where do these prices come from? Somebody just make them up? Does Firstrade say, oh, geez, I don't know. Here's a price for you. No, it doesn't work that way at all. What the way that it actually works is on the exchanges, there are people who are called market makers. And market makers, well, they make the market. They're the ones who put those bids and offers out there. That's what I did for many, many years. I stood down in the pits of the Chicago Board Options Exchange with a funny colored jacket on and put out hundreds and hundreds of prices that were dynamically updated all day long. Now, how did I know what prices to put? Well, I needed to know what the option was worth. And in order to know what an option is worth, we need a mathematical model. It's complicated. There's a lot of crazy math involved in it. So I would run an option pricing model. And even though it's, there's a lot going on, they're pretty complex. To understand it at a high level, like the forest level, not the trees level, it's easier to understand than you think. There are only 6 inputs into a stock options value. There's the current underlying price, which we know what it is. There's the strike price of the option, which we know what it is. And there's the interest rate, which, I mean, we basically know, we have to project them going forward for as long as the life of the option, but we have a pretty good idea what those are. Dividends, we mostly know, generally stocks either keep the same dividend policy. Some of them try and raise it a little bit once a year. Ones that are in trouble sometimes cut it, but we can make a pretty good guess on that. Time, we know. We all have a calendar. And then volatility. So volatility is this input into the pricing model, and that's the tricky one. And it's tricky because the word volatility can mean, it can actually mean several things. To an option trader, there's two main words, or two main contexts of the word volatility that are actually basically two different words. They're kind of homophones, if you will. There's realized volatility and implied volatility. Now, realized volatility, let's skip down here. The synonym for that, look, we're using all these grammar terms here. Homophone, synonym. Geez, what else can we talk about? Onomatopoeia. Pow, I did that one. Okay. So synonym for realized volatility is historical volatility. And basically what that means is it's how much the stock has moved around, right? When you think of the word volatility in context of a stock, if the stock is going crazy, it's a lot of realized volatility. If the stock is really boring and barely moving, it's a little bit of realized volatility. So that's really, really simple. Now, what exactly, it's mathematically calculated. So if it's mathematically calculated, exactly what are the units? How do we calculate it? Well, we take the annualized standard deviation of the stock price. We just basically take the closing prices from the past, usually month, find the standard deviation, and then annualize it to make that month representative of 1 year. Simple. If the term standard deviation is new to you, JFGI, just freaking Google it. But honestly, you don't even have to. All you need to know is realized volatility. I look at the number. The bigger it is, the more volatility. The smaller it is, the less volatility. Implied volatility, well, that's like on the Rocky and Bullwinkle show when they would say, now for something completely different. It's completely different. What it is it's how cheap or expensive options are. Now, you might look at that and say, how cheap or expensive options are, what does that have to do with volatility? Well, it has to do with the reason why people might buy or sell options. Look, I was just looking at the S&P 500 before this class today. And I was thinking we're within like less than 2% of the all-time high. And there's a great deal of market uncertainty. And the PE ratio of the S&P 500 is above the long-term average. I don't know, maybe, and one of the reasons why it's up is because there has been talks in London between the US and China. This is for those of you who are watching this live. You're watching this recorded. This is from, what is today? June 10th of 2025. So that's what was going on today. So that's one reason why the market is up. A lot of optimism about those talks and such. But what if those talks end up becoming not as good a thing as the optimists think? So I was looking at buying puts and I didn't buy any. I look at a lot of things. I like to think through scenarios in my trading. But when do people want to buy puts? Why didn't I buy them? Well, people buy puts when they believe that a stock might be more volatile in the future. If I had more conviction that, hey, I think the market's really going to sell off, there's just too much uncertainty. I don't want to sell my shares, but I'm nervous. I want to protect them. Then I would have bought puts. So people buy, and if I were thinking about buying a stock, but I was worried about it going down, I would probably buy calls instead to have less capital at risk. So people buy options when they think that there's likely to be more volatility in the future. And they sell options, my Substack, and my podcast are all about covered calls and cash cured puts. When the market's kind of boring and not really moving a lot, that's when people sell the covered calls and cash cured puts so that they can harvest that premium. So there is this correlation between option buying and selling and expected future volatility. So that's what implied volatility is. If we skip down to the textbook definition here, implied volatility is the volatility figure that, when entered into an option pricing model, yields a theoretical value reflecting current market prices. It's interpreted as the market's estimation of the future volatility in an asset based on the buying and selling pressure, the supply and demand pressure that affects the option prices. It is the volatility implied, the future expected volatility implied by option prices. Now, that is also stated in units of annualized standard deviation. So you can compare realized to implied volatility. But, the standard deviation, like, how does that translate into actual option prices? Because look, if you buy or sell an option, you actually do make or lose money based on implied volatility. But the option price, like, that's in dollars and pennies, right? So how does this annualized standard deviation percentage figure translate into dollars and cents of option prices? Well, it's done with Vega. Vega is one of the option Greeks. Vega is the rate of change of an option value relative to a change in implied volatility. And it's measured in dollars and cents. So if implied volatility goes up 1 point and the Vega is 7 cents, the options go up by 7 cents. It's like Vega is like the translator. It translates implied volatility to actual profits or losses. And so it's really important to track implied volatility. If that's one thing that you're going to make or lose money on, you better be looking at it. If you're not looking at it, I mean, you're kind of just winging it. That's like driving a car, but, just taking the rear view and side view mirrors off it. Like, okay, you can drive the car, but you got a little handicap visually there, right? It's not the best way to drive the car. You might inadvertently crash into somebody every now and then. You could drive it, but it's not a good way to do it. It's exactly the same thing when it comes to implied volatility. Yes, you'll make or lose money from the stock going up or down. Yes, you'll make or lose money from time passing. But yes, you will also make or lose money from volatility. If you ignore volatility, you're not going to make money in the long run. You might make money sometimes. I mean, you will make money sometimes if you make enough trades. As they say, even a blind squirrel finds a nut every once in a while. You'll probably find more nuts than your typical blind squirrel. But overall, you're going to starve in the winter. So we need to use what is called volatility charts. And if you don't currently have a tool that gives you access to them, Just Google it. They're out there and you can find them for free, I think. Here's how they work. The x-axis is time, just like a regular stock chart. It's the date on the bottom. And the y-axis, which is the vertical axis, like on a stock chart, that's the price. On a volatility chart, it's the annualized standard deviation unit. It's volatility. Now, this can be displayed different ways. Time is variable. You can look at it over a 6-month period or a year period, maybe. You can look at the 30-day volatility or maybe the 60-day volatility on some platforms. But let's take a look at stock charts here for a second, okay? So this is the S&P 500. Prices are not current. I want to say this is from, well, here, hold on a second. I'll tell you when this is from. I'm just looking at my Firstrade platform on the other screen here. This is from, let's see, we got 2 red, 1, 2, 3. It's from a couple of days ago, like 4 days ago. Yeah, about 4 days ago. So we're looking at this, and I look at this, and if you're like a newer option trader who hasn't been trading for a long time, you're just learning. All you do is directional trades with options. You look at this, and what do you see? You see, well, this is an uptrend. It's a very sharp uptrend. We have higher highs and higher lows. Will the uptrend continue? I don't know. You know, fundamentals drive the market as well, and we're waiting on a lot of things right now. But, you know, maybe you want to play this to the upside. Okay, great. If I buy some calls, then if it goes up, I should make money. If it goes down, I should lose money. But that's the directional component. That's one thing that will make or lose you money. What if you hold it for 4 weeks, right? You buy a 4-week option, you hold it all the way till expiration. Well, time decay is going to eat away at a lot of that. It might go up enough for you to still make money, but if enough time passes, it just makes it harder because everything you make on the stock going up, which is delta, you might lose on time passing, which is theta. Now, if you've made more than 10 trades, you come to the realization that theta is something you need to look at, right? So, okay, we look at delta, we look at theta, but what about this vega? What about this implied volatility? How exactly does that fit in? Because it's really easy to understand, hey, directional, buy calls, stock up, good. Easy. And it's, you know, it becomes easy to realize time passing, bad. Need move to happen faster, you know, caveman trader. Up, good. Time pass, bad. That's it. But it is a lot harder to wrap our head around volatility. So let's take a look. So the 1 day to expiration, don't really care too much about that because if we hold it all the way till expiration, it's not going to have any time premium left anyway. So we don't really look at the 1 day to expiration too much. But if we go out like 25 days to expiration here, it starts to matter a lot. And we look and we see, oh, well, maybe I want to buy these 50 strike or 50 strike, 594 strike calls. Well, they have a 1507 volatility. What does that mean? Well, it has a few implications that are really important for you to gain edge on your option trade. Remember, The lay definition of implied volatility is how cheap or expensive options are. If you look every day at this, or if you go online and you find a volatility chart, then and you see that, oh, this is a lot higher than it usually is. Well, if this is a lot higher than it usually is, that means options are more expensive than they usually are. If you say, oh, 1507, this is lower than it usually is. Well, that means options are a lot cheaper than they usually are. Okay, so that seems pretty esoteric, and that seems pretty just hard to wrap your head around. Like, okay, cheap or expensive, but how much? I don't know. I don't really get it. Well, if you look at the Vega column, you're going to get it. Let's say implied volatility is usually around 16.1 or something. It's 1 point lower than the average over the last year. Well, if it's 1 point lower, because it's usually 16.07, then it's usually the options would be 62 cents more expensive, 0.627145. Just round that to 60. Well, I guess we round it to 63 cents. That means right now the option is priced at whatever it is. But if the implied volatility were 16.07, what it usually is in this hypothetical example, then they would be 62 cents more expensive. So we're getting them at a 62-cent discount. If we look at the chart and over the last year, it's usually 14.07. Well, then right now, they're more expensive by 63 cents. Usually they're 63 cents cheaper. So we're overpaying on our options by about 62 cents. Let's look at another chart. These prices are not current. This is not a recommendation. I'm just showing you some examples. So this chart, you look at it, and by the way, this is not a stock I trade. I don't have a position in it. I don't have an opinion on it. I am not suggesting to be bearish or bullish or anything. It's just an example. But somebody might look at this and say, oh, well, I see lower lows and lower highs. Oh, well, I'm going to call this a downtrend that I apparently think it's going to continue in. Okay. Maybe I'll buy some puts for this hypothetical example. Okay. Going to buy some puts for this hypothetical example. I know if I buy puts, if the stock goes down, I should make money on the directional component. But I also know that if too much time passes, I'm going to lose based on time passing, based on my time decay or my theta. But I also know that implied volatility via Vega is going to either give me a head start or put me at a disadvantage. It's either going to give me positive edge or negative edge. So that being said, how do I know? I can't just go and look at the option chain and say, oh, well, let's buy puts. What's the price? I don't know. It doesn't matter. I want to buy puts. It does matter. It matters massively. I mean, if you need to buy a car and you go into CarMax, they're the ones who sell used cars, right? CarMax, I got that right? You don't just say, hey, I want to buy a used car. How about like a trusty Toyota Camry. I know those last. And he says, no, here's a 2017 Toyota Camry. And you say, yep, that's the one I want to buy. And get my checkbook. How much is it? It's $100,000. Okay, $100,000. Endorse the check. Tear it off. Here you go. Do you do that? No, you'd be an idiot if you do that. That doesn't make any sense. Why? Like, you're price sensitive. Price matters, doesn't it? You just got ripped off if you're paying $100,000. I mean, Toyota Camrys, they're trusty cars. My daughter had two of them. She actually wrecked them both, but that's another story. She had two of them. They work great, unless you're a bad driver. Then they don't work at all anymore. But $100,000 for a 8-year-old car? I mean, I don't care how good it is. So you do that with cars. What about the grocery store? Oh, yeah, I have cereal every day. I'm going to go buy a gallon of milk. Okay. Oh, here's a gallon. Oh, it's only $50? Okay, well, just put that in the cart. Oh, let's see. Maybe we should buy some ground beef and make some burgers tonight. Meatloaf. Back up. $50 for a gallon of milk. What are you, crazy? Now, that being said, you get to another point in the grocery store and, you need some, I don't know, hot dogs. I like me a good hot dog every now and then. And you go and you look at the Hebrew National, because I think those are the best hot dogs. And you look and you're like, oh, okay. Oh, they're on sale. Buy one, get 10 free. Okay, I'll buy those. Throw them in the freezer. Comes out to like 20 cents a pack. Why wouldn't you? You're getting a good deal, right? So it works the same with options, exactly the same with options. If you're just like, oh yeah, I'm bearish, I'm going to buy puts. What price? I don't care. I'm just going to buy puts. You're making a horrible mistake. So we could look at the 43-day ones, or we could look at the 197-day ones. Now, which ones do we buy? And there's other choices here too. I'm just giving two examples. Which ones do we buy? Well, a big part of that question has to do with how long you think it'll take for the move to happen, right? And there's different analysis that you'd probably want to do to make that decision. If you are looking to hold this for the next, 6 weeks, 42 days, and you buy the 43-day options, well, all of the time premium disappears by then, and you're kind of at a pretty big disadvantage. When you're buying options, you usually need to buy more time than you think the move will happen. So I don't know, maybe your time horizon is the next 2 months, 60 days. Okay, in that case, I could theoretically buy either of those. Now, I know that the 197-day ones are going to cost more. So if all of a sudden the stock turns around and goes up like a rocket ship, I risk a lot more with those because they're going to cost more. But sometimes you get what you pay for, right? Not always, but sometimes. As long as you're paying attention to cost and value, you can if you're smart. So here, I see that these, like maybe, puts are on the other side here. These puts, I might want to buy let's say the 20 strike puts. Well, they have an implied volatility of 33. Now, these 20 strike puts, sure, the premium is going to be higher, but they have a implied volatility 5 points lower. So relatively speaking, they're a better deal. And they're going to have lower theta, which you can see here in the column second from the right. Get about almost half the theta with the longer term ones. And when stocks go down, what happens to implied volatility? Who are some of our experienced folks here? What happens to implied volatility when a stock goes down? Usually, not always, not in all stocks. Where's some of our clever folks here? Oh, boom, Justin. Thank you, sir. Implied volatility tends to go up when stocks go down. Oh, okay. So I want to make sure it's not already overpriced, but I might actually get a boost if the stock goes down. Because if I'm buying an option and implied volatility goes up after I buy it, I make money on Vega. Let's say I buy these and the stock goes down another $2. Well, I make money on direction, on delta. If it happens over a short period of time, I don't lose much on theta. But let's say implied volatility then goes up 3 points, which it might and probably will if the stock goes down a couple bucks over a few days. Well, if it goes down 3 points, how much do I make in addition to delta and in addition to gamma? Anybody know? Or in addition to delta and not counting what I lose on theta. If it goes up 3 points, if implied volatility goes up 3 points, how much do I make as a result of implied volatility going up 3 points? Who can tell me this? If you can tell me this, you are doing pretty darn good. If you can tell me this, you know some stuff about some stuff. I think somebody's going to be able to tell me. Nobody? Okay. I think we got some shy people here. I think the more advanced folks would be able to tell me. Well, if implied volatility goes up 3 points from, say, 33.2 to 36.2, because the Vega is let's call it 17 and a half cents. It's 17 and a half times 3. What's 17 and a half times 3? 52. My math is correct, right? 52 and a half. Okay. So in addition to what I make on Delta, which how much would I make on Delta? The Delta is 14 cents. If it goes down $2, I'm going to make 28 cents. Let's say that happens over 2 days. Well, I'd lose about a penny. So I'm up about 27 cents. But Vega goes up, implied volatility goes up 3 points. Wow. Then I make an extra 52 and a half cents. That ends up actually being more important than Delta. Big deal. I bet you didn't really think about the fact that there's something more important than the direction of the stock, even on your directional trades. Hey, I think the stock's going down. I'm going to buy a put. Okay. Well, I actually care more about Vega than Delta. This is how you get edge on your trades. This is how you get a positive expected value on your trades. By just being a little bit more smart, you can potentially make a lot more profit in the long run, right? Not on every trade, but maybe on every trade. If you make a tiny bit more on your winners, lose a tiny bit less on your losers over 50 trades. That adds up, doesn't it? How about this one? This puppy's a freaking rocket ship. Or at least it was. Here, let's see how it's doing right now. Oh, this is the one John was telling me about. John's our head coach. Come on, baby. Real-time chart. What the heck? Hold on a second here. Oh, these are intraday. Oh, I think these are intraday candles. Oh no, I typed the wrong symbol in. What is going on here? Well, it doesn't freaking matter. CRVW. CRVW. Huh. Well, that's weird. Anyway, doesn't matter. So this one just up over the past 2 months, went from 50 to 150. Oh my gosh. It's funny. I mean, I guess this does matter. I'm looking at CRVW. I bet it's CRWV. Ah, CRWV. Well, I guess I got to fire John. Don't tell him. He's going to be sad about it. Mark, the last one, it was 17. Was it 1.7 cents? Hold on a second. Oh, no wonder, Mark. 1.7 cents. I was off a decimal point. Thank you, sir. Kind of thought that was like a pretty big Vega. So thanks. I appreciate it. Whoopsie whoops. Okay, so anyway, this is CRWV. Massively up. And it's been up a couple days since then. Now, I am not recommending this stock. I don't know if it's going to go up or down in the future. In fact, tell you the truth, I looked at it the other day and I was looking at it from a fundamental long-term valuation standpoint. And I thought these were crazy valuations. I thought it was very, very expensive. But, as they say, the market can remain irrational longer than you can remain solvent. So I'm not shorting it or anything, that's for sure. But anyway, we look at this and, if you wanted to play this to the upside, this sure would be a good covered or not covered call, long call candidate, because if it can go up really, really fast over a really, really short period of time, well, there's not a lot of theta damage. But the implied volatility is dizzying. This is one where the options are just going to be massively, massively expensive. 20 Vega. If implied volatility changes, well, here, what are the option prices? Let's take a look at this sucker here. This is an up-to-date version of this. There. As you can see, this puppy just started trading not too long ago in end of March. So, okay. What are the option prices here? Now I go to trading, I go to options, and we go to CRWV. I go to get option chain. Obviously, we're not going to look at 3 days here. What were these? These were like July 18th, December 19th. So look at some longer term ones. Geez Louise, you buy these 150 calls. Well, 155 calls. These are basically the at the monies. They're $16. That's 10% of the stock price. I mean, goodness gracious. It's got to go up 10% just to break even. Although, you know, you look at the charts and it can go up 10% in a day. But what was the Vega here? 20 cents. Now, when the implied volatility is in the 200s, the implied volatility doesn't change 1 point at a time. It might change 5 points at a time, 10 points at a time. So, I mean, 5 volatility points changes the option price by $1. It's a lot. This stock goes up I'm looking at puts. If this stock, but still, it's the same numbers. If this stock goes up by, we should look at the 155 calls. If this stock goes up by $5, this is going to go up by the option's going to go up by about 350, right? $5 times 0.67, about $3.50 ish. No, hold on a second. Do you ever have one of those days where your math skills are just off? Good thing I'm not in a job where I need math skills. Yeah, $3.37. Stock goes up by $5. Option price goes up by $3.37. But if 2 days pass, if that goes up over 2 days, they're going to lose $1. So now it's up $2.37. And if implied volatility goes down 10 points, because the stock goes up, usually when stocks go up, implied volatility goes down, not always. In fact, in this stock, it's probably the opposite based on the term structure, or not term structure, but the skew. Talk about that more in a minute. Implied volatility went down 10 points. These would go down by $2. Basically, if this stock goes up $5 over 2 days and implied volatility goes down 10 points, you barely break even. You do break even by a little bit, but you barely break even. It's crazy, man. It's freaking crazy stuff. Right? Now, I mentioned the word skew. Let's talk about skew. Skew is the observation that options on the same underlying may have different implied volatilities. There's vertical skew, which is the volatility difference among the strikes, and then there's term structure volatility, which is the difference in volatility among the expirations. This is vertical skew. See how this is in Mara, which is crypto. See how the implied volatility changes over the strikes? And this is actually sort of an anomaly. Usually the implied volatility is lower the higher the strike. Like here, let's get this back over here. And let's look at Apple. Oh, sorry. Oh, what was that? July 18th. Okay. See in Apple how the higher the strike, the lower the implied volatility. That's pretty typical. That's normal. So the way professionals do this is they might look at the strikes and say, okay, well, every strike higher, the volatility goes down by about, a 0.5%. But maybe the stock's going lower and people are buying, like the professionals are buying a lot more puts. Well, now the lower the higher, between each strike, it's $1 difference. So what professional traders will do is they'll do like, oh, well, these are 3 points higher than usual. These are only 1 point higher than usual. I'm going to sell these and buy these and wait for them to come in. And I'm going to make money on Vega. As far as term structure of volatility goes, which is, hey, if we're looking at the 220 strike calls in all these different expirations, well, they all have different term structures as well, or they all have different volatilities as well. These are 26.7. These are, 27, 37, like they're all different. And so what a lot of people do is they'll compare them for different expirations and they'll say, well, if there's no earnings or anything announced, there's no announcements, no reason to believe that volatility should change much, in the near future between May and July, say. Well, then why are these such a high volatility? If I multiply the price difference or the volatility difference of 6.2 points times the Vega of the May, well, the Vega's, going to be, or the May options are going to be expensive, more expensive than they should be. So a lot of people will just buy time spreads then, especially professionals. But I do this I used to do it as a professional trader, but now I do it as a non-professional too. Sell the expensive one, buy the cheap one. This is a big part of my earnings trade strategy. So the objective on these skew trades isn't to like buy an option, buy a call, see the stock take off and make tens of thousands of dollars. It's to profit by the volatility moving a little bit, and it's just a couple of points times the Vega times the number of contracts. So if it's just a couple of volatility points and the Vega is, pennies, say 20 cents, 20 cents of option premium times a 3-cent move, well, that's 60 cents, which is $60 of money. If you're trading a one lot, it's kind of foolish. It doesn't make much sense. But if you're trading 100 lot, well, that's $6,000. Okay. I might make some decent money. But what about skew for the rest of us? So skew is very, very important in your trading. If you trade spreads, you're trading skew, and so you should strive to profit from it. Time spread results, like calendar spreads, time spreads. Anybody trade time spreads or calendar spreads? Now we're going to have to schedule one of those for the future. If you only trade time spreads when the shorter term volatility that of the option you're selling is higher than the volatility of the longer term one, and there's no volatility events before the shorter term one, you're statistically going to do better than you otherwise would. We use volatility as a screen for time spread candidates. Like this could be a time spread, right? 1 day to expiration. Well, usually when it's 1 day to expiration, I don't put a lot of stock in the IV, but maybe it's 2 or 3 days to expiration. Sell it at 55, buy it at 49. Now, don't get me wrong. The ones with 15 days to expiration, they're going to have bigger option premium, but relatively speaking, they're cheaper. So these, you're selling something that's overpriced relative to something that's fair priced. Does that make sense? Does anybody have any questions about anything that we covered before we move on and call it a day? One thing I will say about time spread candidates is the most important thing is that it's range bound, right? If you've ever traded a time spread, and I've done a Firstrade webinar on time spreads, check out Firstrade's YouTube channel and review the time spread one. And if you don't see one, just tell me or Firstrade to schedule the time spread one. I can do that. Most important thing is we need range bound stocks. The closer it is to the strike price at expiration, the better. And the second most important thing is avoid earnings, unless it's intended to be an earnings trade, which is just a different animal altogether. And screen it by, hey, only if the front volatility is a lot higher than the back volatility. That's when I trade it. If you do that, you're giving yourself an edge on volatility trades or on time spreads. And look, trading's hard, right? It's hard to predict the future. I mean, you can't predict the future. Arguably, because you can't predict the future, arguably the only way to make money trading is by getting edge. And the edge ends up becoming what your long-term profit is. It's from a purely theoretical standpoint. All right, if you missed it before, Wealth Building with Options podcast, please listen to my podcast. Even if you've never listened to a podcast, just try it out. If you have an Apple or Spotify account, go to markettaker.com/applepod or markettaker.com/spotifypod. That'll take you right to our podcast. Just give it a listen. If you're folding the laundry, doing some gardening, riding your bike, running, driving, anything where you can safely multitask, this is purely audio. Walking the dogs. Every time I say that, my dogs go, they like look up, their ears go, bing. Did you just say what I think you said? I'm ready. Let's go. But they already went this morning. We took them for an early morning one. But yeah, give it a listen. Just give it a try. And if you have listened to podcasts and you're into options, it's a no-brainer. It's free. Please give it a listen. That being said, friends, have a great rest of your day. Trade smart. And next week is a really good one. It's asset allocation for option traders. That's a really important one. Okay, friends, I will see you next time. Trade smart, and we'll see you soon. Bye.